The VT Downing Unique Opportunities Fund invests in UK equities. We are investing across most of the market capitalisation range in companies above 100 million market value. So we're investing in small caps, mid caps, and a few FTSE 100 companies. But the main focus is on mid caps and their equivalent companies on the AIM market. And to give you a sense of it, the median market capitalisation is very broadly in the £2 billion range. So the fund is a concentrated fund holding 25 to 40 companies. Generally, it would be in the middle of that range. We're looking for exceptionally good quality businesses that can demonstrate to us that they have superior returns on capital. Usually these businesses also have, and it is what we look for, they have a moat or a barrier to entry that keeps the competition out over many years. The kind of barriers that we're looking for would be intellectual property, brands, high switching costs, so it's expensive to switch to another product with a different provider, or being the leading platform or the leader in a network. So we're looking for all those attributes, and valuation is also important. We value companies based on cash flows. We look into the future, we forecast conservatively, we discount those cash flows back at 10% per annum, and we buy companies that are at or preferably below intrinsic value. So the fund is concentrated, and so one of the risks is volatility, which is around the fact that there are maybe around 30 companies in the fund, and so if one or two of them have a very good or a very bad announcement at any point, that can lead to more volatility than if you were owning a fund with an awful lot of companies in it. A second risk is that we avoid certain sectors. So we don't invest in oil and gas or mining companies because we don't believe that we can forecast the mineral price. We also don't invest in banks because we don't know what's under the bonnet, and banks are often subject to windfall taxes and heavy regulation. So the fund is skewed to certain sectors and not involved in others, and that can be a risk. So we have our own ESG team, and they will vet and do a report on any company that we are considering investing in. So they will look at all the factors, they will grade the company, and that is the first line of check. They will also keep monitoring those companies and regularly scoring them after we've invested. And it's important to say that we have no companies that ratings agencies would consider to be a severe risk, and almost none that would be considered high risk in the fund. So it would fit into a portfolio where the investor wanted UK equities, and perhaps they might have a FTSE 100 tracker. This would fit excellently with that because we mainly invest in mid caps and small caps, and our FTSE 100 exposure tends to be at the lower end. The other place that it would fit really quite well is if you had a mainly global portfolio, because a lot of global funds tend to invest in very, very large companies, whereas this fund does not, and there would probably be virtually no overlap at all.